G'day folks, welcome back to another upgrade for high grade copper and US crude oil. Now both charts are showing cautiously bullish momentum. So before we go any further, make sure you hit that like and subscribe button to support the channel. We'll include some back testing as well. First of all, the outlook for US crude. WTI prices hover around 63.73 with market sentiment cautious due to the escalating trade tensions and potential US recession risks. The International Energy Agency has revised global oil demand growth for 2025 down to 730,000 barrels per day, citing economic uncertainties. For high-grade copper, prices are maintaining a strong uptrend since 2020. Analysts project a 3% rise in 2025, driven by supply constraints and steady demand despite weaker than expected Chinese consumption. So first we'll look at the long-term trends on the monthly, the weekly and the daily. Now, for those, I did have a question from one of the viewers saying he trades on the daily, and if you're doing that, you only need to look at the daily and the weekly predominantly, but also look at the monthly as a potential trend and on any instrument you trade. If you're trading on the lower time frames, then what you do is you change these three charts to the 1 hour, for example. If you're trading the 1 hour, the daily, the middle chart, and the weekly is the first chart you look at. The monthly is probably not as important. So basically what I'm saying is you go down to the lower time frames as needed, depending on what time frame you're trading. Okay, so back to what we do here. We do cover the whole lot from the monthly right down to the 1 hour time frame. So again, the monthly is showing a bullish momentum, nice big bullish run since that was the start of 2024. It did dip initially into that moving average range on the price chart, and the CCI broke below, but it's still been moving above that since. Now this month so far has been a somewhat negative move, but nothing too strongly on the downside. Still predominantly a bullish momentum. Do note, however, we do have this very slight, almost a double top on the CCI versus high highs in the price. That could effectively possibly be a bearish divergence, so we'll just keep an eye on that, but at the moment, nothing too dramatic. On the weekly, it was bullish and it's broken down into that moving average range, and you can see there's a fresh breakout above the CCI moving averages. The price is already above that, so again, bullish momentum, fresh bullish momentum on the weekly. On the daily, if I zoom in on this one, after hitting that resistance at 53.953, it bounced down from that resistance below the moving averages on both the CCI and the price, and since then it's made a recovery above both. But just do note, the moving averages on the price haven't actually started to turn up yet. I prefer to see them sort of narrow like it did back here, for example, and that would have been a better area to go long. This could be a bit premature and could be a false break, so just be aware of that. I like to see these moving averages contract and then start rising like it did back here. Nonetheless, we're still going to consider that a potential bullish move with both price and CCI broken above. And this CCI 1500 down here just gives you a smoother, longer term trend, if you like. So during this period, if you're trading on the daily, that would have been predominantly long trades every time it broke above the CCI and price areas as well. So predominantly long trades. This recent area was short, and now it's a fresh breakout to the upside again on the daily. Now if we go to the intraday chart, the 1 hour chart, if you're trading on the smaller time frames, at the moment you'll be taking long trades only on the 1 hour time frame. So if you look at the intraday chart, we take long positions from that point around about the 20th of April. That's where that back test of the stop loss approach and the average down start. And you would have had two trades on both the stop loss and the average down, and both reaping $332 returns. And that's where the CCI and the price broke above the moving averages on the 1 hour time frame. Now if we go back, just another back test as well to show you, if we look at the short positioning, so had you gone short during that period when that candle broke below into that moving average range on the price, the CCI was below it at that point. That's where these two back tests start for shorts. And you would have stopped out the positioning, both trades, when the CCI broke into that moving average range. And that's indicated roughly around this area, just before our last video. So the stop loss approach has lost about $150, and the average down approach has generated $1,463. So again, you wouldn't have taken any of those trades from there on both of those, on either of those strategies. So here we've got US crude. You can see here the price is still below the moving averages on both the price and the moving average of the CCI 150. So bearish momentum on the monthly. On the weekly likewise, although I've got a bit of a pullback so far this week in those three candles, and moving higher slightly, and that's shown here on the daily as well. So if we zoom in on the daily, it actually came down and bounced through that moving average range of the CCI, not quite through the top of that moving average range on the price chart, but again, notice the CCI 1500 is still predominantly bearish at the moment. I'd like to see this break a bit higher if possible, and that'll be a bit more of a lagging indicator. And remember, there's no such thing as a 100% perfect indicator. All indicators are lagging, so what we do is look at probabilities. So that's why we look at the long-term trends. And again, if you're looking at trading at the smaller time frames, you would just change these three charts to the smaller time frames, as I said previously. And if we go to the intraday chart as an example, you've got the 1 hour chart and the daily here. So predominantly at this point, cautiously going long. You could probably start some long trades, but at the moment you see there we did have this, during that shorting period, we did have a bullish divergence, higher lows on the CCI versus lower lows on the price since our last video, and that actually bounced through our minimum target range. And that minimum target range, for those new to the channel, if we do a Fibonacci, is we'll take it to the recent high before that divergence started, and that's a 23-38% range as a minimum. It hovered around there initially for a number of hours, and then it finally broke higher. And now it's just actually broken above the 50% level and approaching this. Previously it was a support line, now it's a resistance, and that corresponds with that 61% almost. And here we have the back testing on crude oil. Now, one thing I want you to notice is we've got the stop loss approach and the average down approach. Now, if you let them all run, so we've started the back testing on that candle on the daily where it broke below the price, and the CCI also was a fresh breakout to the downside. So that's where we've started this back test on the stop loss on the average down approach. Now, if you let it run through there, you'll notice the price has appreciated since then, and both have fallen into a negative territory. The way to avoid that, or some of the indicators, you don't just follow this blindly and close out the trades when that happens on the daily. You also look at the time frame you're trading, in this case the 1 hour. Now if I zoom into this for a moment, you'll notice here on the price chart, the first indication we had here was a bullish divergence. So you can see there, from that point to there, we've got lower lows. And from that point to there on the CCI, we've got higher lows. And that's a first indication of a bullish divergence. So theoretically, had you been going short, straight after that, the price started rising, and the CCI kept rising as well. And that was a second point there: lower lows on the price, higher lows on the CCI. So you can see there, had you closed out your positions at that point, and your first sign of a bullish divergence, both the stop loss approach and the average down approach generated about $360. So always pay attention to these divergence. I use them as an area to get out of trades. I don't use them to trade. In other words, I wouldn't be going long and going to aim for that, because that gives you sometimes that can be a very quick move. So for example there, you could have actually got into one of those candles, but again, that would have been a very limited upside. And since then, the price has been going sideways, been against the trend anyway. So I prefer to use these divergences as an exit point, and that's where you would have got out of that trade ideally on both the stop loss and the average down approach, and you would not have traded these periods. So if you're new to trading, we're now including a weekly video series called Pete's Investing Plus One as part of the Pete's Investing channel. The Plus One videos are a dumbed down version of our strategies and give you a better insight into our analysis and help you follow our daily videos. So if you enjoy the content, it will help me motivated to keep these videos. Subscribe at least on a free basis to the Patreon page, where I publish weekly bullish shares across various regions of the world's markets. Think of it as sitting down with me over a cup of coffee. Thanks, and talk to you in our next video.